So now we want to take a look at break even when a company makes more than one product. So what we need to do is we have to find the weighted average contribution margin, because you probably sell more of one product than the other. So maybe for every 3 products you sell of one product, you only sell one product of the other. So it could be cell phones and cell phone cases, right? So a lot of people, they don't buy their cell phone case at the store where they buy the cell phone. They buy it cheaper online. So you don't sell as many cell phone cases as you do cell phones. Plus, your contribution margin for your cell phone is probably going to be a lot higher than the contribution margin for the cell phone case. Okay, so we need to, for every product, take the contribution margin per unit and multiply it by the sales mix. So let's say for you'll sell one cell phone case for every 6 cell phones that you sell. Okay, so the contribution margin per unit for the cell phone times 6, that's the contribution margin. And then to get the weighted average contribution margin per unit, you add up the contribution margin for the cell phone and the cell phone cases, and then divide it by 7, because it was 6 cell phones, 1 cell phone case. So that was the total in the basket. Okay. So here's another example. Regular posters and large posters. So for every 5 regular posters you sell, you will sell 3 large posters. So if there were 8 posters in a basket, 5 of them would be regular, 3 of them would be large. So we can see we found the contribution margin by subtracting sales price and variable cost per unit. We got the contribution margin per unit multiplied by the sales mix. So the 5 regular, 3 large posters. And so then we got the contribution margin that would be in the basket for regular and large. Add that together. That would be our total contribution margin in a basket divided by the 8 units in the basket. So 20 is our weighted average contribution margin per unit. So to get our break even, the fixed expenses, operating income is 0 when you're breaking even. So we just divide the fixed expenses by that weighted average contribution margin per unit. And then when you know how many units in total you need to sell, then you can figure out the break even for each product. So take that break even and divide it by the number of products in the sales mix divided by the total sales mix. Okay. So here's an example. So they make nightstands and chairs. For every 8 chairs they sell, they'll sell 2 nightstands, right? So 10 is in the basket, 8 chairs and 2 nightstands. Contribution margin per nightstand is $350. Contribution margin per chair is $280. Fixed costs are $15,000. So the contribution margin gets multiplied by the sales mix. So the $280 times 8 gives you $22.40 in the contribution in the basket for chairs. $350 times 2 gives you $7 contribution margin in the basket for nightstands. So if we add together the contribution margins, $29.40 divided by the 10 units in the basket, the 8 and the 2, $29.40 divided by 10 gives you $294 is our weighted average contribution margin. So we're going to take the $15,000 in fixed costs. 0 is the target operating income because we're breaking even. We divide that by that $294 weighted average contribution margin, and that tells us we need to sell 5,103 units in order to break even. So to figure out then the break even for nightstands, how much of that 5,103 needs to be nightstands versus how much of that 5,103 needs to be chairs. So 5,103 times, there were 2 nightstands in the basket of 10. So 5,103 times 2 divided by 10, or 20%. means we got to sell 1,021 nightstands. Break even in chairs. So 5,103 is the total units we need to sell. In the basket of 10, 8 of them would be chairs. So 8 divided by 10, 80% of what we need to sell needs to be chairs. So 4,082 is your break even for chairs. So a little bit more involved if we have more than one unit. So you can see we're looking at this more simply, but once you know the basics, you can do more difficult, more complex situations. The last part of the chapter deals with looking at risk. And when we're looking at risk, 2 calculations we can do to see how much risk we have: margin of safety and operating leverage. Okay. Margin of safety tells you how far your sales can drop before we can get to the break-even point. So how much can we drop before we get to a loss? So the way we calculate that is we take our projected sales and divide and subtract our break-even sales. Okay? And we can do that in units, or we can do that in dollars. We can also figure out the margin of safety percentage by taking the margin of safety and dividing it by the projected sales. So that'll tell us the percent that sales can drop before we start operating at a loss. So here's our example. We've got our sales in dollars and sales in units. And so we can subtract the sales minus the break-even sales. And when we subtract, we get margin of safety $71,421 or 7,142 units. Our selling price must be 10. So then we can get our margin of safety percentage. Okay. So we're going to take the 71,420 margin of safety, divide that by the 125,000 sales revenue, 0.57136. If we make that a percentage, move the 2 decimal places, that rounds to 57.14%. And it would be the same whether you did it in units or dollars. And so that tells you that your sales can drop by 57.14% before you're operating at a loss. Okay, so companies may have been doing this during the COVID crisis when they could see they weren't going to be able to operate, they weren't going to be able to generate revenue. Okay, and so, at that point, they were trying to see, okay, so at what point are we going to be at a loss? What point are we going to start losing money? Because we still got to cover our fixed costs. So that's why it's been so tough for businesses. Okay. So current sales are 20,000. If break-even sales are 16,000, what is the margin of safety percentage? Well, the margin of safety would be the 20,000 minus the 16,000. So sales could drop by 4,000 before we're at break even. So what's the percentage that they can drop? 4,000, divide that by the 20,000 in sales. So 20% is the margin of safety percentage. Sales can drop by 20% before we're operating at a loss. All right, and then the last thing we want to look at is operating leverage. So how a company's operating income will change when there's a change in volume. So the lowest possible operating leverage factor is 1. Okay. The company has no fixed costs, because fixed costs can be risky, indicate risk, because you have to cover those fixed costs even if you're not operating. That's why these businesses that had to shut down during the COVID crisis, they still had to pay their rent or their property taxes or what have you. There were certain costs that they were incurring even though they weren't operating. So we take to get our operating leverage factor, we take the contribution margin, we divide it by operating income. So that's why the lowest one is 0. right? Because that would mean there's no fixed costs when your contribution margin is your operating income. And so if you have a high operating leverage factor, right? So, I mean, 1 is the lowest. So as it gets above 1, the higher the operating leverage, that means that you have higher levels of fixed costs, higher contribution margin ratios, a higher risk, but there's a higher potential for reward, because after your fixed costs are covered, then your contribution margin is going to go straight to operating income. Low operating leverage means you have more variable costs and lower fixed costs. So you're going to have a lower contribution margin. So there's less risk, but there's less potential for reward, right? Risk and reward go hand in hand. The more risk you take on, the more opportunity there is for reward. So let's take a look at an example. Here's the operating income for a company, the contribution margin statement. And so what would the operating leverage factor be? Well, we would take the contribution margin and divide it by the operating income. So 14,000 divided by 2,000 gives you 7 as your operating leverage factor. So that's pretty high. Let's see what that means. That means for every 1% change in volume, your operating income is going to change by 7%. So if your sales volume increases by 20%, the percent change in operating income, 20% times 7, your operating income is going to change by is going to increase by 140%. So this is the reward part. We've taken on the risk, we're going to get a reward. Sales volume increases by 20, but look how big our change in operating income is, 140%. So let's see how that works. So the change, 20,000 times 20% is 4,000 increase, right? So that's how we got from 20,000 to 24. And same with variable costs, 6,000, and I'm just going to multiply by 1.2. That's how we got to 7,200, right? 1,200 is 20% of 6,000, right? Fixed costs would stay the same. And we can see operating income went from 2,000 to 4,800. So that was our operating increase by 2,800. If you take 2,800 divided by the 2,000, that was the 140% increase. So that's well worth it. Here's where the risk comes in. Let's say sales volume decreases by 20%. So revenue went down by 4,000. The variable costs would go down by 1,200. Fixed costs stay the same. So now instead of having an operating income of 2,000, if sales volume decreases by 20%, we now have an $800 loss. Our operating income decreased by 2,800. So that was a 140% decrease. 2,800 divided by 2,000. There's our decrease. So that's where the risk comes into play, right? For every 1% decrease in sales volume for this company, there's going to be a 7% decrease in operating income. So a 20% decrease in sales volume resulted in a 140% decrease in operating income. So you're taking a big risk when you have structured your costs in this manner. Okay? And so that's why operating leverage is also an indicator of risk.